What is the price-to-rent ratio for real estate investing? Imagine trying to decide whether to buy a home to rent out or just rent it yourself. One of the best tools to help with that decision is the price-to-rent ratio. This number tells you how affordable buying a property is compared to renting it. It's a simple calculation but can reveal a lot about market, trends, and property values. Real estate investors use this ratio to see if a market is good for rental investments or if it might be better to wait. The formula is straightforward. You take the median or average home price in a market and divide it by the median or average annual rent for a similar property. For example, if a home costs $300,000 and the yearly rent is $18,000, the ratio would be 16.7. That means it costs about 16.7 times the annual rent to buy that home. A lower ratio, below 15, usually shows that buying is a better deal than renting. It suggests that rental income can cover expenses well and might even generate profit. Investors often look for markets with ratios under 15 because they can expect higher rental yields and better cash flow. On the other hand, a ratio above 20 indicates that buying is expensive compared to rent. This can mean lower returns for investors, and that renting might be more affordable for residents. Markets with ratios between 16 and 20 are considered balanced. They need closer analysis because other factors like local job growth and property prices also influence investment potential. When the ratio rises over 20, it can signal that home prices are growing faster than rents, which might point to an overheated market or lower rental returns. Investors use the price-to-rent ratio to screen different markets and properties quickly. It helps them identify where rental income can cover costs comfortably and where property prices might be too high. Changes in this ratio over time can also show market trends. If the ratio is rising, it might mean home prices are outpacing rent increases, which could be a warning sign. Conversely, a falling ratio suggests that rents are catching up or property prices are stabilizing, making the market more attractive for rental investments. Some investors combine this ratio with other measures like the rent-to-cost ratio, which looks at monthly rent compared to the purchase price plus repairs. This helps them get a clearer picture of cash flow potential. Overall, understanding this ratio helps investors make smarter decisions about where and when to buy rental properties, balancing the costs, rental income, and market conditions to maximize their returns.